afternoon, everybody. It's my pleasure to welcome you to this State of the Market Quarterly Review webinar. We're glad that you could join us. And today we have Nathan Larson giving us the presentation. As a few introductory items, just so you're all aware, we do have a Q&A available. So if you do have questions, feel free to use that chat. And we will be stopping for questions during, so if it is relevant to what Nathan is covering, we can pause and cover that. And we'll also have some time at the end to answer questions that you might feel are more general that you'd like to cover. And with that, I can get right into introducing our speaker. So Nathan is a seasoned financial expert whose depth and experience spans more than 15 years with Squire. He joined in 2008 and has since become a trusted advisor in the areas of financial planning, investment management, and retirement strategy. His expertise also extends to tax compliance and pension assurance services, where he helps clients navigate even the most complex financial landscapes. He has worked extensively across a range of industries, including nonprofit organizations, mining and energy, oil, gas, and insurance, bringing a well-rounded and practical perspective to every engagement that he gets to be a part of. And he's particularly passionate about evidence-based investing, helping clients build long-term wealth through discipline and research-driven strategies. And his background in corporate and partnership taxation, as well as multi-state and international tax reporting, makes him an invaluable resource for clients with sophisticated planning needs. So with that, we'll go ahead and turn the time over to Nathan. And like I said, we'll be answering questions on the side if you have them. But that said, go ahead, Nathan.
Thank you, Tucker, and thank you everyone for joining us today. We're going to spend a few minutes talking about what happened in quarter 3 of 2025. So just as Tucker said, let's try and utilize the Q&A for all of your questions. We want to make sure that we tailor our information and presentation to the things that are on your mind. It's been a up and down roller coaster year, a lot of excitement in the markets, and we're going to just dive in and kind of look back at what's happened. Okay, so here's where we're going today. We've got a market summary. We're going to talk a little bit about the world stock market performance, and then we're going to dive into U.S. stocks, international developed stocks, emerging stocks. We're going to take a little fun jaunt and look at which countries are performing well, which ones aren't, and everybody in between. We're going to look at real estate, commodities, fixed income, global fixed income, and of course, one of the hot topics this year and this past quarter is AI is everywhere. How much AI are we holding in our portfolio? So we're going to talk about that. Okay, the quarter 3 was an amazing quarter. So the markets across the board were up, very positive. You can see the U.S. market was up over 8%. International developed was up over 5%. Emerging markets was up over 10%. Real estate was up over 4%. And our bond markets were positive as well. And just to kind of put that into perspective, you can see that next line down since January of 2001. The average quarterly return on the U.S. stock market was 2.5%, and quarter 3 gave us 8%. So well above average, really good quarter, a lot of good positive things happening, and investors were rewarded for being in the market. You can also see, for perspective, some of the best and worst quarters back in 2020. Just after the COVID dip, we had a 22% quarter. Same with international markets, 25. Emerging markets and real estate had their best quarters after the real estate bubble in 2008, and kind of when the market started to turn back positive, they had the big gains there. And some of those big losses in the worst quarters, those are scary numbers there. You can see real estate, for example, was down 38% in one quarter back in 2008. So we all remember that scary time. Hoping to never repeat it, but we did learn from it, and the markets have continued to reward investors, and that's what we saw in quarter 3. So kind of looking into the long-term numbers and where we're at, if we look at the 1-year returns, we've had very positive returns in everything except for real estate. Real estate sort of suffered a little bit the past few months. particularly we've got interest rates that have increased, and that's slowing down the real estate markets. But everything else really above average returns for the rolling 1 year period. And same thing with 5, 10, 15, and 20 years, all really positive results. You can see another red arrow on the 5 year bond, US bond market numbers, and that's when, we're kind of still coming out of the rapid increase in interest rates. We went from basically zero interest rates up to five or so really quickly, and that impacts bond rates. And now, we've had in the bond market, the Federal Reserve has lowered interest rates. We're expecting some more lowering to come over time, and that should kind of stable out that 5 year bond average return. Bonds are paying more now too. So as those maturities roll over and new bonds pay higher rates, that negative should kind of wash itself out on the 5 year number there. A couple
Hey,
other
Nathan,
things. Oh yeah, Tucker.
this is a good time to ask a question. We've seen a few come in when it comes to international markets and
Okay.
how Squire is going to be positioning client portfolios in regards to international now that we see it done well. What is Squire's stance on international market versus U.S. markets, and what do you see as the potential of domestic versus international equities?
Yeah, great question. We'll talk a little bit more about that. There's some slides down the way here that dig into that a little more, but this particular slide you can see as we go down in time frame. So as you get down to, if we look at 20 years, for example, the US stock market's returned just right out of a little bit above its average. Long-term average for the US stock market is around 10% annually, and that's what it's delivered, 10.75. If we look at the international developed markets and emerging markets, those averages are lower than expected and lower than historical. So really, the U.S. market's been right where it should be based on historicals. International market's been lagging the past 20 years, and that's been frustrating and hard for a diversified investor to stick with a diversified plan. We have seen as we get down into the presentation, and it kind of shows in the 1 year numbers, we have seen really, really strong performance in the international markets this year, particularly. So we'll get to the specifics, but the message there is it's, being a long-term, well-diversified investor can be hard when areas or parts of your portfolio tend to underperform. And the kind of the tendency or the temptation is to jump in there and make changes as we see these numbers come out. And had we done that earlier this year before international kind of came back, we would have suffered there. So it's still, our message is still to stay well diversified. It's okay to have a country home bias, and we're starting to see our international allocations drift from 40% to maybe more like 30%. Somewhere in that range is appropriate for international diversification. And we don't want to jump in based on these results and say international is not a good place to invest right now. And the reality is we just don't have a crystal ball to know what's going to perform on a short term, and long term. 20 years does seem like a very, very long time, but it's really a blip in the investment world. And we just, our recommendation is still to stay diversified. So we'll get into those international numbers a bit later. Uh, this slide, the next two slides are really kind of a fun timeline on some of the big news events that have happened this year. And the graph there just kind of shows the all country world stock market index and its reactiveness to those news stories. So we did get the new tax bill. We've had a lot has happened this year, actually. We had the tariff trade war kind of stuff happening earlier this year, where the market was really negative for a while in the first quarter, and it's marched back since then. There's some other fun headlines there. Um, Overall, the market it does its thing. These headlines do have some temporary impact, but to try and have an investment strategy or a trading strategy around the headlines is a loser's game. We just never know how the market's going to react, and we can't predict ahead of time what these news events are going to be, number one, and then number two, we can't predict how the market's going to react. Sometimes news will come out positive and the market will still go down, and sometimes news will come out negative and it'll go up, and all sorts of variations of that. So it is fun to look at these things and pay attention to what's happening out there in the investment world and in the global kind of macroeconomic world. But overall, the things that matter to an investor's experience and performance is having a well thought out plan that gives you the best chance to meet your goals over the long run and manage the risks along the way. And that's what we help our clients do when we work with them. Here's a couple more headlines coming out. We do have the government shutdown happening. These are the past 12 months, so there's some more here, but we're on 20 days of a government shutdown. I think the longest ever shutdown was 32 days or 36, I can't remember exactly. And that was back when it shut down under the Trump administration, his first presidency. So we'll see that the news is, there's some pressure on Congress to get a deal done this week. That's sort of the desire from the Republican side, at least. So we'll see if they're able to get anything done and get the government funded and continue there. But generally, in this government shutdown has happened quite a bit over the past, little while, and the market usually doesn't react any particular way to that. It's kind of irrelevant in the long-term outcome of the market. All right, so when we dive into US stocks, we kind of break them down by size of companies and growth versus value. And small value was the strongest performer in the third quarter, which is nice to see. There's a premium that we expect to earn on small value stocks because the companies are riskier a little bit. They have higher growth potential. And so it's nice to see that small value premium show up. It hasn't always been showing up recently. If you look at that table there, the first row is small value as the quarter performance the year to date. And as you kind of go down, the 20-year average on small value, much like international, just hasn't been there. So it was nice to see that show up this quarter. 20-year average on US small value, just over 7%. Historically, that's been around 12%. So you can see kind of the lag in that performance. And some of these things we expect them as, just from a statistical perspective and from a theoretical perspective, we still believe that there's a premium for investing in small value stocks. And so if we kind of learn or apply our statistical analysis to those, they're due, right? They're due to have a comeback and revert back to that 12% mean. So we don't want to give up on small value stocks. We still believe there's a premium for investing in them. You can look at large value. That's U.S. large value companies. Those were the worst performing over the quarter, and value stocks overall in the U.S. have been a little bit performing under their average. So kind of same message there. We still believe that value is going to outperform growth over time. There's a premium there, so we would still want to allocate. And if you notice, one other highlight I want to make is large growth stocks have really been outperforming their average. So the average on large growth stocks is probably 10% or so annually, and the 20-year average on those large growth stocks that we've seen is 13%. So we know that there's a lot of highly concentrated companies in the S&P 500, which represents some of those large growth stocks, and they've really just done super well. That outperformance, we don't know if it's going to continue like that, but over time we would expect a reversion to the mean, and that's why we want to stay diversified. We still want to own those stocks, but we also want to own other stocks like small value, large value, international stocks. Overall, the weighting of the US stock market is about 63% of the total global market. So if an investor were wanting to just buy the global market at market weights, that's the percentage that they would own. And typically our recommendation for US exposure is between 60 and 70% of your equity allocation. So international developed markets, This is interesting that value showed up in the third quarter. So we didn't see that in the US side of the market other than the small value, but overall value showed up strong in the international markets, and growth was the lowest performer. And the international developed markets overall make up about 26% of the market weighted global stock market. Emerging markets had good performance as well. Typically, emerging markets are around 10 to 11% of the total global market. Growth was what showed up the most in the emerging market sector. So value, you can see it down a little lower. Large cap outperformed small, so kind of an opposite of what we would expect. But on any one quarter, very normal to have these things jump around and not have small value be the top performer across the board. Let me pause there. Tucker, do we have any other questions coming in?
There have been some questions about interest rates and how the rest of the year will pan out. If there's any questions or comments on maybe predictions or what economists are saying for the rest of the year.
Yeah, so we just had a federal rate cut back in September. We're expecting some more, maybe one or two. The hard thing that the Federal Reserve is dealing with is inflation is still above its target. So inflation came in at 2.9% year over year, and the target is closer to 2%. So we're still suffering from higher than expected inflation, and the Federal Reserve's in a really tight spot. They would like to lower interest rates, I think, but they have to manage that inflation as well. And so that's difficult. The other side of that is unemployment. So unemployment's just over 4% now, which is still historically low. So with the higher inflation, a little bit higher, lower unemployment than maybe average, those two things indicate that the market and the economy is still hot. And so it's difficult for the Fed to lower interest rates. If they wait too long, they can push, the country can go into recession, the economy can go into recession. And so they're really just kind of steering this big ship in these micro adjustments. It's hard to control it. And yeah, they're just in a difficult spot. But we are expecting at least another quarter percent rate cut, and maybe two by the end of the year. So we'll kind of see. With the hotter economy, the GDP's up from expectations this year. It's 3.9% year over year is kind of the most recent expectation after third quarter. After the second quarter, which we have the numbers on, it was 3.8%. So the economy is still hot, and interest rates is a way that the Federal Reserve can help. They're not really trying to slow it down, but maybe hold it off a little bit so that we don't get out of control there with big changes in the unemployment and the inflation. Those are the two mandates that the Fed's really trying to monitor. So great question. We will talk a little bit more about interest rates when we get into the bond section of the presentation. Okay, this one's just kind of fun to look at. This doesn't really drive our decisions in our allocations or in our investment strategy, but this does show the third quarter returns in the markets by country. So Egypt is our top performer this past third quarter. And again, we don't make decisions here. If we had a crystal ball and we could tell that Egypt was going to be the best performer, we would load up on Egypt, and probably even more than that, we would load up on the specific stocks that we know are going to outperform. But because we don't have that crystal ball, or we have it and it's always cloudy, so to speak, then we stay diversified. But it is fun to kind of look at this. So the global's right there, somewhat in the middle. The US did a little bit better than the global market overall. That looks like India, the Philippines, and Denmark were the worst performing countries in the third quarter. But most of the country returns are positive, and that's reflective in what we experienced in quarter three with the positive returns. Let's take a look at real estate. So real estate markets kind of softened over the past year, 2 years. A big factor is the rise in interest rates. There's also other factors. office space is, a lot of people are working from home now, and office space maybe declining there. And then there's just other factors on the real estate. The real estate market did go up quite a bit during the COVID years, and it maybe went up too fast. Who knows? But it has sort of softened. The 1 year U.S. real estate investment trusts returns down just under 1%, just over 1%. Global real estate, they're positive returns, but it has made a comeback year to date, looks like the global real estate market, but overall real estate's kind of softened. Um, okay, commodities has been interesting. We, especially with gold and silver prices going up recently, wanted to talk a little bit about that. So the gold is really commodities investing is really kind of a speculative type of investment. Gold over time has held its value and kept pace with inflation. And gold's up right now. So the tendency might be, hey, do we want to allocate more to gold in our portfolios? And over time, gold has a place as a store of value, but it doesn't really produce any income. It's not an income producing investment. It's a speculative investment. So the only way to earn a return on gold is to buy it low and sell it high. And that will happen naturally as inflation grows and the store of value holds. But over time, gold hasn't really been that great of an investment. So I've heard it said that back in, when Christ was walking on the earth, that an ounce of gold could buy a Roman centurion a nice set of clothing. And now, an ounce of gold, if we kind of fast forward the clock hundreds of years, could buy a nice, you know, business executive suit. So it's really just kind of been holding its value over time, and we wouldn't really change our thoughts on gold. Now, it can be something that people buy on the side to feel comfortable or sleep at night, and that's okay as long as it doesn't impact the long-term outlook on the client's financial plan and the portfolio returns overall. So, and there's more to commodities than gold. This includes all kinds of, precious metals. Coffee, it looks like, was the top performer in the commodities market. But what's really interesting about commodities, the performance has been decent over the past 10 years or so, 5 years really good, 11.5%. But if you look at the 15 and 20 years, commodities really have been flat. And their purpose in a diversified portfolio, if an investor wants an allocation there, is really just to be a hedge and a non-correlated investment to the market. So commodities don't always move with the market. And so in a down market, it can be good to hold a little bit of commodities. But over the long term, outlook of a client's portfolio, commodities are really just going to lower returns overall and kind of drag the returns of the equity markets down. So okay, here there's just a lot on this slide, but this is getting into the interest rates and the bond markets. We can see here by the graph that the interest rate curve is starting to look more normal now. It's upward sloping other than the first 3 months. So we've got kind of an inverted curve for the first three months here, but then the curve flattens out and is more upward sloping, which is a more normal shape on a yield curve. We expect that interest rates, as you extend maturities, the rate should be higher, right? And that's where you get the upward slope. And that's practical when you think about it from a CD perspective. If you were to go to the bank and get a CD, they generally and should charge or pay you more interest on a longer term CD because you're locking up those funds for a longer period of time. And so we've seen that happen. This rate curve has been inverted at different times over the past couple of years as we've experienced big swings in interest rates. But you can kind of see where the average bond market rates are just around 4%, almost 5% on corporate bonds. So it is nice to be earning interest once again. If we rewind back to 2 years ago, we had zero interest rates, so it was hard to find yield in the fixed income markets. Now it sort of feels more normal, and we are expecting some rate cuts, as we've talked about. The global fixed income yield curves. This has it broken down by a few of the bigger countries. Same message there. The yield curve is flattening out. There's still a little bit of rounding, maybe towards the end, as we're trying to figure, as the bond markets are trying to figure out what the rate cuts are going to be like and what interest rates are going to be long term. But overall, the yield curves have kind of taken on more of a normal shape. All right. Last thing I want to talk about is kind of this AI boom we're experiencing. So, we hear about AI all of the time. We've got the big AI companies and these tech companies that are making the computer chips and programming the AI and trying to figure out how this is going to impact the economy is hard, and it's also been super fast change happening here. So now they're talking about quantum computing and all the power that's going to be needed to facilitate all this AI work that's going to happen at the data centers and everywhere else. And so, super interesting to think about. But these AI companies have done really well on an individual stock level. And so it's tempting to want to go in and buy these AI stocks and have more, maybe over allocate to them. And that, you know, our recommendation is still to stay diversified. And just naturally in a well-diversified portfolio, what these numbers are showing us is that 42.5% of the US stocks, 127 companies, are AI companies. And so if you own a diversified portfolio, you're already getting the market weight of these AI companies. And and so there's not a need to over allocate past that. And there's also another way to think about how this is all going to play out. AI is just one area of there's these stocks that are, focused on creating the AI infrastructure and everything. They're not going to be the only one in the economy that benefits from the AI. There's also all of the other companies that can hopefully use it to be more efficient. There's also all the supporting companies. So power is going to be one of the world's needs is to increase its ability to produce energy and power. And so those power companies are going to benefit. And really, anytime historically when we've had a technology increase, pretty much all companies benefit. So it still makes sense to keep a market weight diversified portfolio. You get the AI exposure naturally, and you also get the other supporting companies that at times might do better than the AI companies based on, other factors. So same kind of thing in the global market. 32% of that weight is AI companies. There's actually more companies there, 213. So AI is fun. It's interesting to think about how it's going to impact our future. It should make us more efficient, which will help the economy overall. And anytime there's been a big technology change, one of the fears is that it's going to reduce jobs. And what's happened historically is that those jobs have been found in other areas of the economy. And one thing that's interesting now that we haven't experienced historically is we have a flat population growth and maybe even a shrinking population growth. And so we are going to have a challenge finding workers to do jobs. And that's going to be something that the global economy has to deal with. We've got immigration that can help there, but that's tricky, especially right now. And one of the other factors here with the AI is we have efficiency improvements that hopefully create the opportunity for workers to be able to produce more, and that should continue to help our economy grow. So that's all the material that I had prepared for today. Overall, good quarter, really good quarter. It's been a really good year so far. We are going to have some market downturns at times. I can't predict when they're going to be, but there's a lot of good signs in the economy that it's growing and doing well. GDP is up, unemployment is still low, inflation is starting to come down from the high levels. The Federal Reserve is doing its job in trying to control the interest rates and the unemployment. And companies are out there trying to earn profits, and investors get rewarded for for that effort. So with that, that's our presentation for today. Happy to stay and answer any questions, and have a great rest of the day.
Nathan, we did have some questions that came in.
Okay.
One of them revolved around AI and how should I assess if I have enough exposure to AI? And there's probably a flip side to the question is, am I overexposed to AI? Is that something I need to worry about, or what does one do in this case?
Yeah. Well, our recommendation is to have a well thought out, diversified plan that fits your needs and gives you the best chance of meeting your goals. You're going to naturally, by doing that, you'll naturally have, if there's a right level of exposure to AI, you're going to have exposure to it, and it's probably a prudent amount just by owning a market weighted, well diversified portfolio. So if you've invested in, if you're heavier on your U.S. growth stocks because you have a large exposure to the S&P 500 or something like that, then you could consider diversifying at this time to maybe spread that risk out a bit, because there is a risk that the growth on those large U.S. large companies, which a lot of those are AI companies, starts to slow and reverts back to its mean. And so a well-diversified portfolio would give you the exposure to the other things that should start to outperform the large growth stocks over time. But it's hard to predict. So best way is just to diversify.
Another question that came in is, what are the best options for fixed income?
Yeah, so the depends on your level of investment. If you have 500,000 or more invested in fixed income, or that's your target allocation, we like to implement a bond ladder strategy. So we're buying, and this helps. A bond ladder strategy is, we go out 5 years and we split your investment up into fixed income investments, bonds, CDs, US Treasuries, uh, types of investments that are safe. We like to keep our exposure to fixed income very conservative and not chase yield, because investors are better off chasing yield in the equity markets. And so we keep our fixed income strategy pretty conservative. And the bond ladder helps you to spread the risk of interest rate changes over time. So we'll buy a 1 year bond and then a 2 year bond and a 3 year, 4 year, 5 year, so that every year 1/5 of your portfolio is rolling forward. And then we're able to reinvest that at the current rates at that time. If you have less than 500,000, there really are some great ETFs, bond mutual funds and ETFs, that can give you exposure to the bond market in a low cost efficient way. So, and this of course is all after you should have, an emergency fund set aside that's at least 3 to 6 months of your average monthly spending in a high yield savings account that's insured by FDIC. And that doesn't replace your bond investments or your equity investments. That needs to be set in place first. But yeah, lots of good ways to get fixed income. Talk to your advisor. We're happy to help put together a ladder or find you the right mutual funds and ETFs that makes sense for you to get that bond exposure. Yeah, good question. Okay, that looks like all the questions so far. So keep them coming. We'll stay on for a few more minutes as needed. Okay, looks like nothing coming in. We'll go ahead and wrap up our webinar for today. Thanks for attending. And as always, reach out to your advisor with questions. They know your situation more personally and can give you the advice you need to help you there. So have a great day, and we'll see you soon.